Hey guys, it's Sasha. Today, the UK economy continues its collapse. Employment data in the private sector in the UK shrank at the fastest pace since January 2021. Remember when the whole world went into panic mode in March 2020 and the economy went into freefall? Well, the collapse in jobs in December just now, today, this month, according to the latest data from the S&P, is about the same as in March 2020. And before March 2020, the last time that employment fell this sharply was when the financial crash was taking place in 2008. This data comes from the S&P Global Flash UK PMI report, which is a survey. So it is not the actual employment data yet, because we have to wait another month and a half for the official numbers to come through. But this report very strongly correlates with what happens with employment data, and the update that we're seeing today is dire. In the same report, the Manufacturing Purchasing Managers Index fell to 45.7. Any number below 50 means a contraction, and you can see on this chart that UK manufacturing, the blue line, has been mostly sitting in contraction over the last 3 years. The orange line, which is the services index, went up slightly and is sitting above 50, which some people interpreted as being a good thing. But if you read the report, it tells a very different story. Rising salary payments and elevated domestic inflationary pressures continued to push up cost burdens across the private sector in December. Measured overall, the rate of input price inflation accelerated for the second month running to its strongest since April. Manufacturers recorded the steepest rise in purchasing prices since January 2023. Average prices charged by private sector firms, meanwhile, increased at the steepest pace for 9 months, led by a robust and accelerated rise in the service economy. Survey respondents commented on the need to alleviate pressure on margins from higher salary payments, as well as general business overheads and greater prices paid for fuel and raw materials. So according to this report, the services industry is expanding because they are beginning to charge higher prices to offset the increase in costs, a large chunk of which is coming from the increase in wages. This is pointing to a resurgence in inflation in the UK, and this is not a good thing. And in a separate report that also comes from Standard & Poor's and also came out this morning, income from employment rises at record rate in December. At the bottom of page 2 it says, furthermore, the rate of salary growth picked up for the third month in a row, with households reporting the largest increase in income received from employment in the series history, which began in February 2009. But then at the same time, if you scroll back up to the first page, the overall consumer sentiment index has dropped to 46.6. It's below 50. It's still higher than it was in 2022 and 2023 when the Tories were busy themselves destroying the economy, but the trend now appears firmly downwards again, and sentiment continues to be below where it was throughout the 2010s. The interesting thing is that the labour market sentiment index is positive. It actually increased to 54.4, a 5-month high, and there haven't been many major public announcements about redundancies. But while people's wages are growing, people seem relatively confident in their wages, the spending power of the same people is collapsing. The spending sentiment index fell to 39.7, which is extremely low, and this points to a big affordability crunch. People are earning more money on the one hand, but the costs are going up just as fast, if not faster. The cost of paying for your mortgage is through the roof. The next inflation report is coming out in 2 days, but the owner-occupier index in the most recent one for October is at 7.4% and rising. The thing with UK inflation data is that rent and mortgage payments have a very low weight in the overall data, only 23% of the index, and that's because the data is diluted by old people who own their property outright, or people who have inherited their house, and people who have a lot of money. Because the average working person who pays a mortgage or rent will usually be paying more like 40% of their income to live in their house. In some parts of the UK, like in London, that is going to be even higher. So in the real world, where people pay a large chunk of their paycheck to rent or mortgage, because mortgage payments have gone through the roof recently with the higher rates, people are struggling financially, even though their wages are also increasing. As the UK economy is disintegrating, Rachel Reeves has just come out and said there will not be an emergency budget in spring. Remember how she also said that there would be no tax increases on working people, and then she went and made £40 billion worth of tax increases on working people. So I am sorry, but when it comes to this new Labour government making promises, I just don't buy it. You know what I do buy? Stocks on eToro, who are the sponsors of today's video. eToro is one of the most popular investing apps in the world for a reason. And recently, eToro got even better because now you can invest in stocks for free. If you are based in the UK, you can deposit pounds into your account and then buy UK stocks, including ETFs priced in pounds, without paying any fees at all. So if you're smart and you want to invest in the S&P 500, you can do that completely commission-free on eToro. And if you want to buy US stocks, you can convert your money into dollars for a one-off fee of just 0.75%. And after doing that, you can keep your money in dollars for as long as you want. You can keep buying and selling those US stocks without any transaction fees. eToro is also offering a trading course worth $2,000 for free. This is a limited time offer, so if you want to check it out and brush up on your analysis and risk management, all you have to do is open an eToro account using my link. So please go and check out eToro and see what you think. The link is in the description and in the pinned comment. So the Labour Party plan is to make sure that day-to-day spending is funded only by tax by 2029-2030. So the idea is that right now the UK government is running a deficit. If you look at the data, the UK has run a deficit pretty much continuously non-stop since the end of World War II. The government keeps spending more money than they make in tax receipts, and the Office for Budget Responsibility is forecasting that the deficit will still be there in 2030, but it will be a bit less, just £70 billion. You know, just a cool £1,000 per person in overspending by the government. What's £1,000 per person between friends, right? Although at the current rate of population growth, that might be more like, I don't know, £15 by the time we get to 2030. But the Rachel Reeves target does not talk about the budget or the deficit. It just says day-to-day spending will be covered by the taxes. And the reason this target is worded this way is because it means you can always fudge your numbers to say that you met your goal. You can always declare whatever the fuck it is that you want within your budget as not being day-to-day spending. What exactly is day-to-day spending? Out of the $1.28 trillion budget that the UK has for this financial year, $332 billion is going towards paying interest on debt. That's 26% of the total budget of the country, more than a quarter being paid in interest on government debt, and this number is continuously increasing. The UK spends more on debt at the moment, more on debt interest than on defence, healthcare and education combined. This is a travesty, but I guess you could go and argue that debt interest is not day-to-day spending, right? So it doesn't count towards your objective. And hey presto, you've met your target, pop the champagne, congratulate yourself, pat yourself on the back. So Labour is confident at the moment, or at least they appear to be confident, they're doing everything right. All the decisions are bang on. You can't ever go and acknowledge that you actually fucked up, right? You keep having to say that you are doing everything right. And they are saying that they're not going to have to do an emergency budget in spring to fix the massive screw up in the budget in October. But at the same time, this is what Standard & Poor's think. While the December PMI is indicative of the economy more or less stalled in the fourth quarter, the loss of confidence and increased culling of jobs hints at worse to come as we head into the new year. Policymakers at the Bank of England may be cautious about cutting interest rates, however, given the resurgence of inflation being signalled, adding further to downturn risks in 2025. And the reason for why they think this is just above. Firms are responding to the increase in national insurance contributions and new regulations around staffing, with a marked pullback in hiring causing employment to fall in December at the fastest rate since the global financial crisis in 2009, if the pandemic is excluded. There are two reasons why Labour increased employer national insurance contributions. The first reason is that Labour invented a black hole and have been repeating the same fucking bullshit about the £22 billion black hole like they are some kind of bunch of lobotomized parrots. The issue is that the majority of this so-called black hole is new spending commitments by the Labour Party that they announced as soon as they got into power. I mean, no shit. If you go and spend a load of money that does not exist of course you're going to have a problem. Call it what you want, black hole, whatever. But Labour also then made election promises to not increase taxes on working people because I guess, well, they didn't actually think through their policies or how they would pay for them. How would they increase the taxes to pay for the things that they're going to be spending money on? And they went and made promises that they would not increase taxes on working people because it would win them the election. So instead, they increased employers' national insurance because they thought they could pretend that this is not a tax on working people because it is technically a tax on companies, even though as far as the companies are concerned, it's a big increase to their cost via an increased tax on the people working for them. Remember that not long ago, the Tories reduced national insurance contributions. Labour could have just gone and increased those national insurance contributions back up, make up a new number. And that would mean, on the one hand, that people's take-home pay would be suppressed, which is a bad thing because it would slow down the economy further theoretically because people would not have as much money to spend. But it would also not significantly increase the cost of companies in a short space of time because the tax would be coming off the total wage bill. It would not be adding to the wage bill. So it wouldn't immediately have a big inflationary impact, number one, and also it wouldn't immediately hit employment numbers as what we are seeing right now. But Labour could not do that. They couldn't go and increase national insurance by the employees or tax or something else. So instead they made a decision to go and pretend that they are not increasing taxes while doing exactly that. Now we are seeing the very first bit of data coming through since that budget came out, right? It's going to take a few months for all the data to trickle through because we have to wait for the data to happen. We have to wait a month and a half, 2 months sometimes for the data on those months to actually arrive. And we have to wait until April for some of these changes to actually take effect, right? But the early signs are abysmal. And Rachel Reeves, Keir Starmer, and the rest of the UK government are all too busy sticking their heads in the sand like deranged ostriches, pretending that nothing is happening. Remember, go and check out eTORO, my sponsor, link in the description. Thank you so much for watching, and I'll see you later.